Welcome to the Deep Dive, where we dig into the source material to really understand the strategies shaping businesses today. Today, we're tackling a really interesting one, the U.S. grocery industry, specifically Sprouts Farmers Market, or SFM.
Yeah, it's fascinating because grocery is, notoriously tough. Huge scale, thin margins, fierce competition. Most chains find it hard to get that high growth profile.
Right. But Sprouts, lately, their numbers look way more like a hot specialty retailer than your average supermarket. They're even getting a premium valuation for it.
Exactly, and that's what we're digging into. We've got this comprehensive due diligence report, and the plan is to unpack how they pulled off this, well, pretty massive strategic turnaround starting a few years back.
We need to figure out, is this sustainable? And why is the market giving them this premium compared to, say, Kroger or Albertsons? What's the secret sauce, and can they keep it going?
Well, to get it, you first have to understand their whole identity. They call themselves a healthy grocer, leaning into this farm stand heritage.
So not trying to beat Walmart on price for everything.
No, not at all. It's about making healthy food accessible, affordable, but for a specific kind of customer. Their official purpose to help people live and eat better, that really drives, everything. What they stock, how the stores look.
And you can really see the payoff in the financials. Let's just throw out the big numbers right away because they kind of set the scene. SFM's diluted earnings per share, it jumped 50% in fiscal 2024. 50%.
Yeah, I mean, that's explosive for any retailer, let alone a grocer.
But that EPS growth is the result, right? The cause is the sales acceleration.
Absolutely critical. Their comparable store sales, the comps, they've seriously reaccelerated. They hit 7.6% growth in 2024, and then Q2 2025, 10.2%.
Wow, 10.2% comp growth.
Those aren't typical supermarket numbers. That's proof the strategy, the one they started years ago, is really hitting its stride. It's got momentum.
Okay, so that acceleration proves something is working. To figure out how they did it, how they went from being kind of a general health-ish store to this focused player, we need to go back to the start of that turnaround. It was all about the customer.
Right. Yeah, that pivot really kicked off around 2019, maybe 2020. Before that, the strategy was, well, a bit muddled. They were trying to be health-focused, but also chasing deep discounts.
Trying to be two things at once.
Exactly. And management realized, you can't be everything to everyone, especially not profitably in grocery.
So they were burning money, basically, on these super price-sensitive shoppers.
Pretty much. They made a very deliberate choice, a strategic trade-off. They decided to stop focusing on, and they were quite blunt about it, the coupon clippers and the deep discount hunters.
And intentional letting go of certain customers.
Yes, shedding the least profitable ones. By doing that, they could stop the constant margin-killing promotions, cut back on broad advertising spend, and just stabilize things. It was the necessary first step for expanding margins later, even if it meant, traffic dipped temporarily as those folks left.
So quality over quantity of shoppers. Who is this quality customer they zoned in on? They call them the attribute-driven consumer. What's that actually mean?
Well, they fit a really attractive profile for a retailer. Demographically, think younger, definitely higher education levels, and importantly, higher income households, often dual income.
And that higher income is key, right?
Yeah.
Especially lately.
It's crucial. It gives them a buffer against economic headwinds. These shoppers are just less likely to trade down on premium or health-focused items when inflation bites compared to the average person.
They're not just buying calories. They're buying into a lifestyle, maybe an identity.
Precisely. That's the psychographic part. They're actively looking for products that fit specific needs: organic, plant-based, keto, gluten-free, you name it. These are people who actually read the labels, care about ingredients, sustainability, ethical sourcing, often more than saving a few pennies.
Which makes them a destination shopper. They'll make a special trip.
That's the behavior that makes them so valuable to Sprouts. They will drive further or make a dedicated trip just for the stuff that meets their specific standards.
So Sprouts doesn't need a store on every corner.
Right. They can be more targeted, place stores strategically where these demographics are concentrated, and those stores become really productive.
And the store itself, the experience, is designed to reinforce that.
Oh, absolutely. The report mentions the open layout, fresh produce right at the heart of the store, visually and, metaphorically. That's not by accident. 58% of their sales are perishables? So they're shouting about their strength right when you walk in.
And it feels different from a giant supermarket.
Yeah, it avoids that overwhelming big box feel. It's meant to feel more manageable, maybe even a bit exciting.
Less like a chore, more like finding something new.
That's the treasure hunt vibe they go for. They have these innovation centers dotted around showcasing new, trendy health products. If you're looking for that niche kombucha or a specific plant-based jerky, Sprouts wants to be the place you think of.
So it becomes a launchpad for smaller health brands, too.
Exactly. It cements their role as a specialty retailer, not just a place stocking the same old stuff.
Okay, so the strategy is clear. Target that profitable, wellness-focused customer and give them a curated, interesting experience worth the trip. And the numbers back it up. Over 70% of sales now from those attribute-driven products. That shift is real.
So, nailing the customer, that was step one. Step two was building the machine to serve them efficiently and, crucially, scale the concept. That meant rethinking the physical store. This is where the capital efficiency story really starts.
Moving away from the big, sprawling stores.
Correct. The legacy Sprouts stores were pretty big, around 30,000 square feet. That means higher build-out costs, higher rent, more staff needed just to run the place. The big strategic shift was designing all new stores around a much smaller, leaner, 23,000 square foot layout.
Okay, 7,000 square feet smaller. That might not sound like a huge difference on paper, but in retail real estate, that's got to add up, right? Why is that smaller size so critical?
It's a massive lever for their unit economics. Smaller box means lower operating costs, rent, utilities, less labor needed per square foot. It streamlines everything. The average cost to build out a new store drops to about $3.8 million. And that includes everything construction, inventory, pre-opening costs.
Right, $3.8 million. That number is key. If you've got this really ambitious goal, like 10% unit growth per year, cutting the cost per store makes that growth way more sustainable. You don't need as much outside money.
Precisely. Lower upfront cost means better returns from each store, which then justifies the whole expansion plan to investors. And the targets they've set for these new small boxes are pretty impressive. They expect them to generate around $13 million in sales in year one, despite being smaller.
And the return profile.
Exceptional for retail, really. They're aiming for a cash-on-cash return in the low to mid-30s% range by year 5.
A 30-something% return on a $3.8 million investment after 5 years. Okay, yeah, that's strong. That fuels the fire for more stores.
It does. And that aggressive plan is definitely happening. They had 455 stores by mid-2025, up from 386 back in 2022. That target of 10% annual unit growth is huge for a specialty player. It means finding, 35, 40 really good new locations every single year?
Hold on, though. 10% growth.
Mm-hmm.
That's a lot of stores. Isn't there a risk they start eating into each other's sales, cannibalization, especially where they're already dense like California?
Yeah.
You said 34% of stores are there. And finding 35-plus prime spots every year that fit the demographic profile. That sounds tough.
That's a really good point, and yeah, it's a major execution risk flagged in the sources. The cannibalization risk is somewhat mitigated by that smaller store size. It lets them squeeze into different kinds of locations, maybe not giant power centers, but smaller, visible spots closer to those target neighborhoods.
Okay, so flexibility in site selection.
Right. And they're actively working on the geographic risk, too. They know they're heavy in California. The expansion focus now is heavily weighted towards the East Coast. Florida's a big one they mention, with plans for the Midwest and Northeast down the road.
Diversifying away from California.
Exactly. They see a long runway. The report mentions a theoretical potential of over 1,000 stores nationally.
So using the efficiency of the small box to systematically enter new regions, spreading the risk beyond just California's high costs and regulations. Smart.
That's the idea. And that efficiency also supports their growing distribution network, which is vital when so much of your business is fresh food.
Okay, let's get into the engine room, how they actually make more money. The strategic choices on products and operations. This is where we see that margin expansion happening, starting with their own brand. The Sprouts brand private label.
Yeah, this might be the single most important piece of the whole turnaround. Are not hiding it. They're trying to copy the playbook from Trader Joe's, from Costco, make the store brand the reason people come, not just a cheaper option.
Building a moat with their own products.
Exactly. And the scale is impressive. Sprouts brand hit $1.7 billion in sales in fiscal 2024. That's 22% of total sales. Back in 2019, it was only 14%. End of 2024, penetration was up to 23%.
And they keep adding to it.
Relentlessly. 300 new Sprouts brand items in 2024 alone. Remember, that target customer, they want attributes. If Sprouts can create its own high-quality, organic, plant-based, whatever it is product under its own name...
It serves two purposes.
Right. First, the financials. Private label just has higher gross margins. You cut out the national brand's marketing spend, their distribution costs. It's structurally more profitable. That's a built-in tailwind.
And second.
Loyalty. If you love that specific Sprouts brand gluten-free bread or their organic salsa, where else are you going to get it? You have to go back to Sprouts. It drives that destination trip.
Let's stick with that margin story for a second, because that really explains the premium valuation. How big a deal is that structural tailwind from private label compared to, say, a traditional supermarket?
Oh, it's transformative. It's why comparing Sprouts directly to Kroger on margins doesn't quite work anymore. Sprouts' gross margin climbed from the low 30s a few years ago to 38.1% in fiscal 2024. 38%.
Wow. And traditional grocers?
They're usually hovering in the mid-20s, right? Maybe 24%, 26% gross margin.
So Sprouts is keeping an extra 12, 14 cents on every dollar of sales compared to the big guys, just at the gross profit level. That changes the whole financial equation.
Completely. It gives them so much more room to maneuver, and that flows down. Their operating margin went from 3.9% in 2019 up to 6.5% in 2024. That steady expansion, driven by smarter promotions and that private label growth, that's the engine behind the 50% EPS growth. That's what the market is rewarding.
Okay, that structural advantage is huge, especially since, as you said, 58% of their sales are perishables. High reward, but high risk if they mess up freshness, which brings us to the supply chain.
Right. They have to nail freshness to justify the farm stand image and the quality promise. So they're investing heavily in what they call an advantaged fresh supply chain.
What does that mean in practice?
It's about speed, location, control. They've optimized things so 80% of their stores are within 250 miles of a distribution center. That tight radius means faster delivery for produce, better temperature control, longer shelf life, less waste.
And they're taking more control internally, too, not just relying on outside distributors for everything.
Yeah, they're moving to self-distribution for fresh meat and seafood. That's a big operational lift, but it gives them much tighter control over the quality and consistency of those critical items. That's expected to help margins and quality even more after 2025.
And the sourcing itself connects back to the brand image. The report mentions relationships with 170 local farmers.
Yeah, that reinforces the whole farm stand thing. When they can credibly say sourced locally, it resonates with that target customer and sets them apart from the giant centralized systems of the Walmarts and Krogers. It connects the strategy right back to the shelf. ####4. Navigating the competitive battlefield.
Okay, so internal execution looks strong, but no retailer lives in a vacuum. The U.S. grocery market is a war zone. Sprouts has to deal with some massive competitors.
For sure. And the segment they're in, natural and organic foods, it's big, $65 billion in the U.S. in 2024, and it's growing fast. Health trends, younger generations. But here's the key context shift the report highlights. Organic isn't niche anymore, it's mainstream. Meaning conventional supermarkets and mass merchants, your Krogers and Walmarts, they actually sell more organic food overall than specialty stores like Sprouts. That flipped sometime in the mid-2000s.
So Sprouts is kind of caught in the middle, offering stuff that's increasingly available everywhere. The report called it a strategic squeeze.
That's a good way to put it. They've got pressure from three sides. At the high end, the premium space, you have Whole Foods, backed by Amazon, huge capital, tech power with prime data, and still a very strong brand name in organic. Sprouts tries to counter by being a bit more accessible, maybe slightly better value, but still premium quality.
Then at the other end, the value private label side.
That's Trader Joe's territory. And they are masters of that unique curated private label, like 80% of their stuff is store brand. Plus, that cult following, no real traditional ads. Sprouts has to nail its own private label to compete with the loyalty Trader Joe's generates.
But the biggest threat, the one the report calls most significant long-term, that's the sheer scale of the conventional players. Kroger, Walmart, Costco.
Their scale is just game-changing. Kroger's Simple Truth private label, that's a multi-billion-dollar brand now, going head-to-head with Sprouts on organic quality and price, and Walmart and Costco. With Kirkland's Signature Organic, they use their massive buying power and logistics to make basic organic items almost commodities at everyday low prices.
Which creates the fundamental challenge. You can grab decent organic chicken or lettuce while you're already at Walmart or Kroger, conveniently and cheaply. Why make that extra trip to Sprouts?
Exactly. And that's why Sprouts' defense, their moat, can't just be, we sell organic stuff. It has to be that curated mix of unique emerging health items you can't easily find elsewhere. It has to be the Sprouts brand private label being demonstrably better or different than the basic organic lines. And it's the nimbleness of those smaller stores fitting into convenient, high-value locations. They're betting differentiation and execution beats sheer scale.
We also have to factor in inflation, right? Even affluent customers notice when their grocery bill jumps 15%.
Absolutely. Persistent food inflation makes everyone more price aware. It puts pressure on Sprouts from the value end. They constantly have to prove that their private label and fresh quality is worth potentially paying a bit more or making that separate trip. If that value perception slips, even their target customer might consolidate trips at the big guys.
Okay, let's swing back to the financials where you see the strategy paying off. We
Mm.
saw the volatility earlier, but those recent comp numbers,
Mm.
they tell a strong story.
Yeah, the comps really show the strategic focus winning out. You had that COVID surge in 2020, plus 9.1% comps, then a tough comparison year in 2021, down 6.7%. But then the recovery and that powerful reacceleration, plus 3.4% in 2023, then plus 7.6% in 2024, and that plus 10.2% in Q2 2025. That signals the strategy is sticky, it's working, driving total sales up to $7.7 billion in 2024.
Now, here's a part I find really fascinating, kind of the financial physics of grocery. Sprouts has this incredible working capital efficiency, specifically a consistently negative cash conversion cycle. Can you break that down? What does a negative CCC actually mean for Sprouts?
Okay, yeah, it sounds technical, but it's actually pretty straightforward and really powerful for a retailer. The cash conversion cycle just measures how long a company's cash is tied up in inventory and operations before it generates revenue. A negative number, Sprouts, was around negative 10.5 days in 2023, means they collect cash from you, the customer, at the checkout. Instantly, before they actually have to pay their suppliers for those goods.
So they sell the groceries, get the cash, and then they have like 10 days or more to use that cash before the invoice from the vendor is due.
Exactly. It's like getting a continuous interest-free loan from your suppliers. It's a built-in advantage of the grocery model if you manage your inventory and payments well. It frees up a ton of cash internally.
Cash that isn't stuck funding inventory.
Right. Cash that's then available for growth, building those $3.8 million new stores, investing in the supply chain upgrades we talked about, and returning cash to shareholders.
Which leads to their balance sheet and capital allocation. Looks very strong.
Yeah, pristine is the word the report uses. They ended 2024 with $265 million in cash, and crucially, zero drawn on their $700 million credit line. Very little debt. That financial health, combined with strong free cash flow, about $445 million in 2024, thanks partly to that efficient CCC.
Give them a lot of options. And their strategy seems to be heavily focused on share buybacks, not dividends.
Very aggressive focus. They see buying back their own shares as the best use of that excess cash. They bought back $238 million worth in 2024. And then in August 2025, the board okayed a new $1 billion share repurchase program.
$1 billion. That's significant.
It's huge, and it acts as a powerful sort of mechanical tailwind for earnings per share. Buying back shares reduces the total number of shares out there, so even if net income stays the same, the earnings per share go up. It boosts EPS growth.
Okay, so they've refined the model, strengthened the finances, boosted margins. Now, how do they keep this growth story going? The report points to one really big potential catalyst coming up in 2025.
Yeah, the big one is the launch of their first ever formal loyalty program. It's planned for a nationwide rollout in the third quarter of 2025.
It seems kind of amazing a retailer like this, focused on repeat business, didn't have one until now. What's the strategy behind it? Is it just about discounts?
No, it's way beyond just discounts. The real prize here is data and building long-term stickiness. A loyalty program lets them capture detailed individual purchase data on that valuable attribute-driven shopper.
So they can see exactly who's buying what.
Exactly. And that allows them to move from generic flyers to hyper-personalized offers, targeted product suggestions, maybe unique discounts based on past purchases. The goal is to drive more frequent visits and bigger basket sizes from their best customers and do it in a way that protects margins, unlike broad discounts. It's a key lever for future comp growth.
Okay, loyalty is big. What else are they banking on to support that 10% store growth target?
Well, continued e-commerce growth is definitely part of it. Digital sales broke $1 billion in 2024, helped by partners like Uber Eats and Instacart. They need that seamless online-offline experience. And just relentless product innovation, 7,100 new items introduced in 2024. Keeping that treasure hunt feel alive is crucial.
Management sounds confident. Guidance for fiscal 25 is 10.5% to 12.5% sales growth, aiming for low double-digit earnings growth long term. But success breeds competition. What are the biggest risks that could throw a wrench in the works?
Well, we touched on the competitive threats, but it bears repeating. That pressure from conventional grocers mastering organics is the #1 risk. If Kroger's Simple Truth or Walmart's organic lines get good enough in the consumer's mind, even if Sprouts thinks their quality is better, they could lose that destination appeal, especially if the price gap widens. Margin pressure is the constant threat.
And then there are the internal risks, just executing this ambitious plan.
Absolutely. That 10% annual store rollout is complex. Finding great sites consistently is hard. What if the new stores don't perform as well as expected? If they only hit, say, $10 million in first-year sales instead of the targeted $13 million, the whole growth story weakens. Execution has to be nearly perfect.
We also mentioned hearing some chatter, maybe anecdotal, about potential issues with labor high turnover, maybe stores feeling understaffed sometimes.
Yeah, the sources mention this as an underlying operational headwind to watch. It's subtle, but important. The Sprouts experience is supposed to be premium. That relies on helpful, knowledgeable staff. If labor costs pinch too hard or morale drops and the in-store service quality suffers.
Differentiation erodes.
Exactly. That target customer is paying for a better experience. If they don't get it, why make the extra trip? They'll just go somewhere else.
Okay, last piece. Valuation. This is a big one. SFM trades at a clear premium. You mentioned around 21.9 times trailing earnings versus Kroger, maybe closer to 17 times. Why the premium and what's the risk?
The premium is the market basically saying, we believe in your growth story, your better margins, your efficient model. They're valuing Sprouts like that high-growth specialty retailer, not a boring supermarket. The risk is what they call multiple compression.
Meaning the market changes its mind about how much to pay for each dollar of earnings.
Precisely. If Sprouts' growth slows down, or if those amazing margins start to slip, maybe due to competition, the market might suddenly decide, hey, maybe 22 times earnings is too rich. Maybe they only deserve 18 times.
And if the PE multiple drops, the stock price falls, even if earnings themselves are still okay.
Exactly. It can fall sharply because the market is fundamentally re-rating the company's future prospects. That high valuation basically means they're priced for perfection. There's very little room for error or disappointment.
The current stock price already assumes a lot of continued success.
It really does. Hashtag #HeadOtrue.
Okay, so let's try and wrap this up. The core debate around Sprouts Farmers Market really boils down to this classic retail battle. Can clever differentiation overcome massive scale?
Yeah, the bull case is pretty compelling. You've got what looks like a best-in-class specialty retailer. They executed a successful turnaround. They have this high-return 10% unit growth plan, a rock-solid balance sheet, great cash flow from that negative CCC, and a big catalyst coming with the loyalty program. They seem to be in control, delivering superior results.
But the bear case sees them as a niche player getting squeezed. Amazon Whole Foods from above, Kroger and the big guys replicating their organic offerings from below, using scale to compete on price. And they're trading at this premium valuation that demands flawless execution in a really tough market, vulnerable if anything goes wrong.
So for you listening, the 3 things to really watch going forward are, #1, can they keep executing that small store expansion flawlessly, finding the sites, hitting the return targets? #2, can they defend those industry-leading 38% gross margins? That means the Sprouts brand has to keep winning. And #3, does that 2025 loyalty program actually work to drive more frequent visits and build real customer stickiness?
That loyalty program feels like the real test, doesn't it? It gets back to that core issue. We know most organic sales happen in conventional stores now because it's convenient. Sprouts' entire bet is that their specific customer will make the extra effort for their specific offering.
Which leads to that final provocative thought. Can a really smart loyalty program, combined with unique private label products, genuinely convince that attribute-driven shopper to consistently skip the easy option at Walmart or Kroger and make the dedicated trip to a smaller, specialized Sprouts store? Will differentiation truly beat scale in the long run? That's a multi-billion-dollar question for the next phase of the grocery wars.
A fascinating battle to watch. Thanks for joining us for the deep dive on Sprouts Farmers Market. We'll see you next time.